So there are 7 main differences between a REIT and a syndication: direct ownership, value volatility, tax benefits, diversification, barriers to entry, investment minimums, and liquidity. First, direct ownership. I've already discussed this many times. You do not own the real estate that you invest in if you are investing through a REIT. I cannot stress this enough. If you're investing through a REIT, whether wrong or right, this is not the purpose of this video, it's that you do not invest in and own the real estate if you are investing in a REIT. You own a stock or a share of a company that's investing in real estate, and you can kind of ride how well they do, but they're typically capped in the low single-digit returns. When it comes to a syndication, you own the real estate you're investing in. So the returns are much higher when it comes to syndication, if done correctly, because if the sale price or the refinance or the cash flow or the tax write-offs are extremely high for a syndication, you are taking part in that because your name is a part of the LLC that owns the real estate. The second difference is value volatility. One of the reasons I love real estate is because you can't just watch a ticker every day when the news comes on what your apartment is worth that day. And many people like to see that, and that's much more usual, or we see that more often when it comes to a REIT, because again, you own a share of a company, and you may be able to see how the value of that share changes in a short period of time. If you're a part of a syndication, you're in it for the long haul. Especially at Leavenworth, we like to invest for the long haul. So not only do we not check how much the property is worth every single day, but we also know that our end goal is to refinance, pull our capital back out, and continue to own that asset as long as possible, generationally. And so the difference here is that a REIT has that value volatility. You will see the value of your REIT go up and down daily, weekly, whereas the value of the ownership you have in a syndication, that is something that should be viewed upon long-term. And that's actually beneficial because then the actual emotions of the investor do not play into your investment. It's easy to get in and out of a REIT. You like the 6% returns, you're staying in. It drops to 4% the next week, you just sell your shares of the REIT. That is for the investor that is after something quick and or wants a small diversification to something that's not offering a lot of upside. If you're in a syndication, you're in it for the long haul. And if the property does really well, then you do really well. The third way that REITs and syndications differ are the tax benefits. This is by far and away the #1 reason investors contact us. Obviously, I feel as though we've done a great job of garnering the respect and the outcomes that investors want through a plethora of ways people can make money and positive returns on investments. But when it comes to tax returns and tax benefits, this is huge in the comparison between REITs and syndications. REITs offer very little to no tax write-offs or benefits. Again, you own a share. You don't get tax write-offs because you own some Apple share. Now, there are gains and losses, and that's at the end of the year, but that's a little different when you're talking about very small amounts of not only volatility of that value, but also small amounts of ownership. You're not owning anything in the REIT. If you own the real estate in a syndication and there is $100,000 of write-offs, if you have 5% ownership of that building, you have $5,000 of write-offs. That is such a huge difference between syndication and REITs because syndications have the ability to allow you as the investor to actually partake in the tax write-offs. The fourth difference is diversification. Now, this can bleed into each other a little bit, but REITs often, when you invest in a REIT, you own multiple properties that are part of that REIT. The most common syndications that are known are sole purpose vehicles or single purpose vehicles, meaning I'm investing in this apartment complex. You know the exact apartment complex you're investing in. Now, syndications, if done correctly, can actually be pooled into funds, which helps with diversification. But as far as how common REITs and syndications are and how they're commonly maintained or operated, syndications are more known for single apartments or single assets that are owned, perhaps a few. There are some funds, but many times it's a few assets, whereas REITs, you own a multitude of properties. You own many properties. The fifth difference between REITs and syndications is the barriers to entry. Syndications are typically, or actually they are always dictated by the Securities and Exchange Commission. So in order to be a part of a syndication, not only do the sponsors or the people operating the syndication need to make sure all the legal documents and everything is taken care of legally through the SEC, But that takes time, and then it takes time for the investor to actually make sure they review those documents and everything is followed per the guidelines of the SEC. This protects the investor, but it also protects the sponsors. REITs, on the other hand, they're publicly traded, and the ability to get into a REIT can happen in minutes because it happens daily. And it's set up once, and then it's very easy to be a part of. The sixth difference is the minimum investments, and it ties very closely to the barriers of entry. The minimum investment for a REIT can be extremely low, $50, $100, and you can get in within minutes. Whereas a syndication takes a lot of time. Oftentimes you need to be an accredited investor, and the minimums to even be a part of a syndication is typically anywhere between $25,000 and $100,000. The seventh difference is liquidity. I discussed this earlier, but it's extremely important. If you're investing in a syndication, you cannot be the type of person that checks on your investments every single day like it's the ticker, like it's part of the marketplace, like you're checking your crypto wallet. If you're part of a syndication, you need to be in it for the long haul. Now, the business plan could be 1, 2, 3, 5 years, or it could match Leavenworth's plan, which is usually 5 or 10 before a refinance, and then we hold indefinitely. So the business plan is to hold for as long as possible. Either way, as a syndicator or through a syndication, you're not checking the value of your syndication as it's publicly traded every single day. This means you cannot get in and out of a syndication very quickly. If you're investing in a syndication, it's not necessarily you're investing in it until you're 63 and a half and you can pull out your 401k, but you do need to have the patience and know that you're illiquid. You're not liquid when you're part of a syndication. REITs you can get in and out of, and that's why they're so easy to get into. Okay, so now that I've gone over the 7 differences between a REIT and a syndication, in closing, I'd like to go over 3 of the most commonly asked questions that we hear. Is a REIT the same as a syndication? I've obviously covered the differences in exhaustion over the last 7 steps. It's extremely easy to be a part of a REIT. The barrier of entry is very low. You do not need to be accredited typically, and you can get in and out of a deal, any REIT, within minutes. The syndication is a long-term play, and now long-term is certainly longer than day. It could be a year, it could be 2, it could be 10, but you need to make sure that you're comfortable with a long-term investment in which you will not be reminded by some type of value ticker every day of what your investment's worth. You need to trust the process, and you need to trust the business plan. A second question that we get is, are REITs a bad idea? Listen, REITs are not a bad idea, and I hope through my explanations I haven't tried to make them sound as though they are. It just is the type of investor. You need to decide what type of investor you are. Are you the type of investor who's looking to participate in all of the gains of the property? Do you want to own the property? Do you want to take advantage of all the tax benefits? Are you not going to check into a public market every other day to see what your 100-unit apartment looks like? And do you want your children and your children's children or your family or your spouse to own what you currently own? Syndication is the route. If you want something that you can dabble in, that you can get into very quickly, that you can pull out at any time you want to because it's very liquid, then REIT is the way to go, especially if you're a non-accredited investor, because you don't have to worry about qualifying for anything. REITs are ways to diversify your portfolio, get in and get out of a deal, and say that you own real estate. And there's nothing wrong with that. Syndication is for the real estate-minded investor who wants to actually put their money to use for the long term. The final question we get is, are syndications good? Are syndications where I want to be? That is by far the biggest question that I get. Now, the majority of our investors are now not first-time investors. They've done this before. They realize they like syndications. In fact, they like our approach at Leavenworth because they've been a part of past syndications where there was a great sale at year 3 and they made a decent amount, but now they don't own real estate. Now they don't have passive income. Now they paid capital gains on the sale and they don't own any real estate. So their children or their spouse or nobody else in their family will ever own real estate until they buy something again. The purpose here of a syndication, especially the way we approach it, is that we're in it for the long term. If you want long-term investments with very high tax benefits and you want to be able to trust long-term wealth and the ability to force appreciate an asset, then syndication is your deal. If you're in it for the long run and you want to reap the benefits of actual real estate ownership, of taking advantage of the tax benefits, of all of the upside of the real estate profits, then syndication is certainly the way to go.